So welcome everyone. Thanks very much for your attendance this evening. So today we're going to talk about investment fees, demystifying investment fees. It's going to be quite high level simply because this is for everyone. Furthermore, this is not advice. For those who don't know, my name is Brian. I run and own Freedom Financial Planning, an independent financial planning firm. We're also one of the only flat fee financial planning firms in the country. Demystifying investment fees. There are several fees that you might get with investing. So what we're going to do is go right into the investment itself, the fund itself, and talk about the investment or fund management fees. So this fee is the fee paid to the company that is managing the money. Let me give you an example. You have a retirement annuity on platform XYZ. In that retirement annuity, your money is in the Signia Skeleton Balanced Fund, for example. That costs maybe 0.5 or 0.6%. That is the fund management fee. So that is paid to the company whose name is at the beginning of that name of the fund, and that is paid for actually managing the money. So that is expressed as what's called a TIC, a total investment cost or a total investment charge. And what that means is it's the cost of running the fund, the profit that has been taken by the fund management company. Furthermore, it's the cost of transacting within that fund. So you'll see there is a TER plus a TC. TER means total expense ratio, total costs, total expense of the fund, and then TC is transaction costs. So the total expense ratio is quite constant. It's constant because the fund management company knows what they're about. They know what they charge. If there's no performance fees, that is, it's quite constant. So if they want 0.5%, that's what they get. The TC is transaction costs. And so for transaction costs, that's the cost of them making trades within the portfolio. So if you have a fund that is quite aggressive in terms of trading, they do a lot of trades. And there are funds like that. They have what's called a momentum style of investing. And they always try and invest in stocks, for instance, that are on an upward trajectory. And then they try and drop them again before it gets too late. So they're not there for the whole ride like a value investor. They're there for the shorter trip. And they trade a lot. And so their TER, their constant fee that they get might be reasonable. But then the TC, the transaction cost, that might be quite high because they trade a lot. And every time you trade, you're buying and selling shares. A stockbroker needs to make money. And so those fees add up. So with investment or fund management, it is the fee for the company whose name is in front of the name of the fund in general. So like the Signia Skeleton Balanced Fund, it's for Signia. This is, you might see, if you have an advisor, you might see this expressed on some of the reports you get. It is for a DFM fee. It's normally like between 0.2 to 0.3% per annum. A DFM is a discretionary fund manager. Many of us advisors are just not good at managing funds. We have CFPs, we are not CFAs. And so portfolio construction might have to be outsourced to an investment consulting firm. And so there might be an additional line item of fees, and that is for the DFM. The administration fee, that is for the investment platform that your investment sits on. 10X, Signia, Allen Gray, 91, those companies, the platform. And on that platform, you have your retirement annuity, if I can go back to the previous example. And within that retirement annuity, you have the fund you chose, which maybe was the Signia fund. But that platform fee is the fee that's charged for actually doing all of the accounting, the compliance work, the reporting work, and so on. It's not a crime for there to be a platform fee. From my experience, and I do have my own portfolio, small portfolio with a DIY kind of platform. I also have my own portfolio with platforms that are available to advisors as well. You often get what you pay for. And so when there is no admin fee for a LISP or an investment platform, then sometimes you can find that the service is maybe not amazing or the reporting is not great. They're not really making money on that function, and therefore they're not putting money back into the business. So just so you know, an administration or platform fee, it's supposed to be quite low. The highest it should ever really be is 0.58% a year, and it should go down on a sliding scale as the money that you have invested with them increases. If you're paying more than 0.58% on the platform, it's probably not a platform that you want to use for the long term. Okay, then I will show you examples of this now in the next few slides, but you will see sometimes there's a line item called other. And you can see I've described rather exactly what other means. It's a gray area. So when those regulations were made, these reporting regulations, the way that everyone reports, I think it is governed by a CISA, which is an organization that sets kind of the rules for all of the insurance and investment companies in South Africa. And so it was nice that they set these rules to say you must report the investment fund management fee, you must report the DFM fee, the administration fee. It's to remove the murkiness and to clear the muddy waters that plague our industry. And then they said, okay, fine, but you can have an other category. Other couldn't be for anything. Often it's like what they call marketing fees, contracting fees, admin fees. Marketing means paying someone for giving them the business, which is an advisor. And so if you see high numbers, high percentages in the other column, then you know it's also probably trash. And I'm going to show you an example of that in a few seconds. Another line item you might see on your investment statement is advice. It could be called advice fee, financial advice fee. This is not an investment fee per se, but because it's always grouped there, it's good to know about it. And this is the fee paid to the financial advisor. So the fee there might be zero if you don't have an advisor, or if, like many of our clients, I think just on half of our clients, pay us directly. They don't want the fee to come from their investments. They want to keep it clean, and they have the cash flow, so they pay us directly. And then when they get the report, there's a nice big fat zero there, but it can only go up to really 1.15% per annum. On a normal clean investment on a platform like an Allan Gray or a Signia or whoever, that fee is regulated. It goes up to 1%, and then obviously VAT on top of it, 1.15. Here's a tip. If you have a fee statement from a product provider for maybe an RA, for example, and that fee statement says advice and it's more than 1.15, it's not great. I would look around if I were you and see what options there are out there. That means the person's earning commission on it and not the normal straightforward investment fee. Commission is, it can erode the gains. I'm actually going to show you the effects of commission on investment growth in a few slides' time. Here's an example of a fee breakdown. I really hope it's large enough because for me it's minuscule. I need a larger laptop. And so what you've got here is, this is actually a snapshot from the Signia Skeleton Fund. I'm picking on them today. I hope they don't mind. And so what you can see here, this is the fund fact sheet, this is the fees section, and this is what I spoke about. What's really important down here is the TER, or total expense ratio. So just once again, this is a consistent fee. This is what Signia in this instance wants to earn for doing the job that they do. 0.46%, that's what they want. TC, transaction costs, are 0.0, was it 8 or 6? 8%. And so that is the cost of trading over the last maybe year. Normally, it's averaged out over the last 36 months. So that TC, that transaction costs, it's obviously a ratio, it's a percentage, and it shows you the total costs over and above the TER that come from them doing trades. So some asset managers just like to move more aggressively in and out of certain asset classes. So there might be people who have a lot of money in equities, 75% maybe, and then the asset manager says, I'm a bit worried about things. I think there might be a crash, and they might go down to 60 or 50% and then load up on bonds. Those are ETFs that they're stocked up with in this type of fund, for example. But trading ETFs can be expensive, and it's a share. And so when you trade shares, there's brokerage fees. that 0.06% relates to transaction costs, brokerage fees. And then you've got the total investment charge, the TIC. So that is the total cost of you investing with that fund manager. Here's another little breakdown here from a proposal, a product proposal that we made for a client. And here you can see this is what it looks like if you go to a provider and you ask for a proposal for a retirement annuity again, or a tax-free, or whatever the case may be. And so on the previous slide where I had those bullet points, this is what it looks like in real life. And so here you've got the administration fee. So this platform, this investment provider in question is earning 0.11% per annum for the administration of this investment, which I think is extremely reasonable. The total fund management fee is 0.45. That is the TIC of the underlying fund or funds. In this instance, I know for a fact, because I drew this up myself, in this instance, there's a combination of funds here. And so there's one fund, there's another fund, and there's another fund maybe, and then it's a blend of those funds. And then what they do is the fund management fee is an aggregation of the total fees. So per weighting, if you give a third to each asset manager, the one is 0.46% maybe, a third of that, a third of the other one's fee, and a third of the other one. Added together, it will give you the total fund management fee, 0.45%. And you can see here, financial advisor fee. This client of ours pays us monthly directly, so their investment can grow unencumbered. And so the total fees for this investment is 0.57%. But what I want to point out here is that the administration and advice fees only need to be deducted in this instance, in this example. If you as the client, if you as the investor rather, want to understand what your net return was for that period. Now, what happens is you often get statements. Every quarter you get a statement from your product provider, and they will say to you, your funds grew by, the performance of the fund will say 10% for the last year. And you say, okay, but what was it net of fees? That's a valid question. I think I've seen that question posted on Facebook a few times as well. So you say, fine, what was it net of fees? What fees do you take off? The fund management fee is already taken off. So the TIC, if it's TIC, what I would say is, an easy way to remember TIC is total internal cost of the fund. I know that's not the correct word. Instead of saying total investment cost, say total internal cost. Inside the fund, that fee is taken away. Okay, the fund manager takes it away, and then it publishes its returns. And it tells you this fund grew by 10%. It's net of its own fees. So the fund management fee, the TIC, it's important, but if you have your returns that are already published, then that it's already free of that fee. So all this investor needs to do now is take their 10% in this example, deduct 0.11%, which is the admin fee, and then they get their net return. And that is how you work out your net return per annum. And so in the next example, in the next slide here, I've shown an example of that. You can always come back to this online and look at this if you're trying to just work it out for yourself. Like I said, this is going to be high level. In the questions afterwards, I will be able to answer some maybe more granular questions. So what you can see here is it's 10% in this example. I just came up with an admin fee of 0.46 just to show maybe what attrition looks like. This person has an advisor who charges 0.5%, and then VAT is added. And so the investment return was declared net of the TIC already. And so this investor just wants to know, fine, how do I work out what my net return is? And then they just deduct administration and advice. Okay. So what happens in the fund stays in the fund. The fees that are applied in the fund stay in the fund. The returns come out net of those fees. So here I said it's total in-fund costs. The incorrect definition or the word, but it helps maybe remind you of when to apply those fees. So We've looked at maybe what the fees look like, a fee breakdown looks like when you get a quote. But now something comes up that's called the EAC. And so the EAC is something, once again, I see a lot of people talking about online, and they comment on it and say the EAC, the fees are quite high. So what is the EAC? It's the effective annual cost. Now, in finance, or at least maths, if you ever see the word effective, it's going to be the impact that something has on something expressed in a percentage. And so effective annual cost, it shows us the impact of the charges on investment returns. It does not necessarily show the investment returns. And this is where it gets a bit freaky. It shows the impact of the investment return, of the charges on investment returns. So rather, if I can repeat that, it doesn't show us the fees, it shows us the impact of fees on the investment returns. It makes more sense when there's commissions involved, and I'll show you that now. So what you want to do is when you're presented with an EAC table, what you want to do is look at the term until maturity. It's the last column, and I'll show you an example of that now. The reason why is because that will give you a good idea of until this policy or investment matures. If it's an RA, if we can flog that example to death, if it's an RA, maybe 65 is when you want to retire, and that thing will go until maybe 65, or it will say 25 years or 35 years, and the impact of fees. In the short term, it's not necessarily that accurate or helpful. The short-term EAC, the 1 year, 3 year, 5 year. The reason is because it shows the impact of the fees upfront, and sometimes there are fees payable upfront to set an investment up. And so it'll always look kind of bad in year one, especially if it is a commission type of product, like this example I'm going to show you now. And surprisingly, if it's an ETF. So what you've got here is a typical life company RA, retirement annuity, also called a legacy or traditional retirement annuity. So these are the bad things that are still floating around the industry and still being sold to death. Old school endowments, retirement annuities, savings plans. People have things called educational plans or policies. Whenever an investment has a weird name, you probably can deduce that it's going to be a low quality investment. That's for sure. And so what you're going to have here is these life company RAs have EACs like this. I'm sure many of you have seen this before. Maybe many of you have seen this and have decided to go onto your own financial journey because it can be quite jarring. But let me explain to you what's happening here. This is lifted off of one of our clients who recently appointed us. They have this from another advisor. And so we looked at it and realized, okay, we know what we're dealing with here. And so what I showed you here is the 1 year, it says 13.79%. So how people generally interpret this is my fees are 13.79% this year. And then over the next 3 years, they average 7.7. Then over the next 5 years, they average 6.1. Okay, that's not accurate, but the fees here are ridiculous. So what's happening here is it's showing the impact of the fees if you end the investment in this thing after 1 year, or you invest it after end it after 3 years. So it's showing how much your value of your investment will be reduced by if you cancel this policy in the next year, or after 3 years, or after 5 years. Now, a rule of thumb is that if you see this type of thing, where it starts high and it goes down quite drastically, and I'm not talking about starts at 1 and it goes down to 0.9, but if it starts at 10 or 12 or 7 and it goes all the way down to 1 or 2 or 3, once again, it's probably an inferior product. The reason why it's so high here, firstly, is you can see the gray area. This is the black hole of fees and commissions. What's happening here is there are a lot of fees being paid out to the advisor because you sign up with them, and they can charge more than 1% a year on these investments. The reason why some retirement annuities, they can do this is because back in the day, what they did was they took a retirement annuity and they wrapped a life insurance license around it. Now, investment fees are limited to 1% per annum. on the ongoing basis, excluding VAT. With life insurance, I think it's limited to 5% a year. The trend seems to be 3%, but it's limited to 5% a year. So if you take an investment like this, a nice clean priced investment, and you wrap an insurance license around it, you can now play the game according to the insurance license's rules. It's not designed for you, it's designed to pay people to sell these things. And so what you have is this example here where this person was earning a lot. And so if this advisor, and so if this client now canceled, there would be clawbacks, cancellation fees, penalty fees. Now, if any of you are watching this and you think to yourself, am I in an inferior investment? Ask the company you're invested with if there is a fee payable to cancel your debit orders or to move the product. If there is a fee, if there's a penalty, I'm sorry, it's probably trash. I know it's not nice to hear, but rather hear it now and get on top of it. You will see why now in a few slides' time why it's important to do. So just to recap, what this shows us is the effect if you cancel now, and then until retirement, this client of ours has 14 years till retirement, or at least until this product is available for use, but they're going to retire at a different date. And you can see now the other is negative 1%. So what they're trying to tell the person here is, look here, there's like potential loyalty type bonuses available. We top you up if you keep your other insurance that's with us in place and you never cancel it and never change it. If you're a good person and you don't hurt us, we will give you these refunds over time, and then it reduces the total fees. And so that is why it's a negative there. It's not exactly like you are doing something right and your investment fees are on a sliding scale and now it gets so favorable for you. It's just that they're trying to hook you. Almost all the life insurance companies have this type of setup. And so if you ever invest money, ask yourself, does the company you're investing with, does their name end with the word life? If it does, maybe don't invest with them or think twice about it, because they're good at giving you life cover. They're not good at investing. That's been my experience. Just another thing, a few things to look out for here. Investment management, it is ridiculously high. This is shocking. However, it's constant. You can see it's constant. It's constant because the investment manager underlying, they can't do this bonuses and all this rubbish. They have to keep their TER, their TIC is quite constant. And so what they're showing here is the investment fee is quite static, but administration and other ones that kind of go down towards the end if you hang around with them. But now I want to show you an example of a better looking EAC. This is from an RA of a quote we did for someone. So every quote that you get from an insurer, for example, or investment company, they've got to display this EAC in it as well. It's law. And so if you have a low-cost provider that you utilize, a good, high-quality investment platform that isn't screwing around with your money, but is charging proper fees that are static, and you know what you're going to pay for now and in 10 years' time, you will see this bottom part here is quite consistent. Okay. The total EAC will be quite consistent because there's no funny money, there's no weird dealings happening here. They're kind of straight as an arrow. One thing I want to point out though, if you get quotes on a unit trust and an ETF, I would compare them. And sometimes you can choose on some platforms to invest in a fund that is either the ETF version or the unit trust version. You can go to the quote where I showed you earlier on the breakdown, or you can go to the EAC and look there, and you will think to yourself, there's under other, there might be a figure that's higher and it goes down after a while. And you might think, but Brian said that means it's dodgy. Not necessarily. If it's low, if it's point something, then it's fine, because that might be trading costs. And sometimes some investment companies throw that in other, or the investment management fee will not mirror what is on the fund fact sheet. So if you ever do a quote with a low-cost provider that you believe is low cost, and you see something in the other category, or the investment management fee is higher than what it says on the fund fact sheet, What it probably is an ETF. Okay, and so ETFs in South Africa can actually be a bit more expensive to invest in than a unit trust. Now, I know for some of you that might be like extremely difficult to understand because we hear all the time ETFs are super low cost, but we do consume a lot of US media. In the US and globally, ETFs are low cost. In fact, I think some jurisdictions it's like 0.01%, 0.02% on some ETFs abroad. And so they have scale and they're able to provide that kind of pricing. What you must realize is that an ETF is actually a share. And so when they buy and sell them is transaction costs, like I mentioned earlier on. They might call it brokerage costs or something like that. In a unit trust or a collective investment scheme, as it's technically known as, you won't necessarily have that, or it will be much lower. The reason is because it's collective. So it's like a bit of communism in a way that you're all paying for each other, your fees. And so there's a spreading of the load across all the units. All the fees are paid across all the units. With the ETF, it's you hold that unit. And so if you're going to transact regularly with an ETF, there will be higher fees, higher than what the quotation might have initially said. Secondly, is if you have an ETF and it's one that you contribute to monthly, there will be probably a higher transaction cost because every month they have to do trades and to buy you another ETF to position you. Just something to keep in mind. Some providers have both options available. For instance, if you have SCI World, if you want to invest in MSCI World, which is not a bad idea. And then what happens is you can say, some providers will say, we have the unit trust version and the ETF version. Do a quote for both and see what they look like. And then come back to the fee breakdown and or the EAC. You might see that unit trust is cheaper. So just bear in mind, when we consume media from the West, from the US and the UK, they will talk about ETFs and ETFs. They often use it as a proxy or as a substitution word for passive investing, indexation. It's not necessarily cheaper all the time, especially if you transact regularly. Okay, so I hope EACs make perfect sense. So this is a real case study of a client of ours to show you what the impact of fees might be. This is a very simple, and I've stripped it down a bit just to focus on the product at hand. So this client of ours, previous advisor, gave them an RA from a life company, and it has about 1.8 million rand in. Monthly contributions are 4,500 with a 5% annual escalation to those monthly contributions. The fees were high. So now you can think in terms of the EAC breakdown. Fees were 0.8%. This is term till maturity. The EAC for this, if I go back quickly, just go back to here. I didn't take the 1 year column when I did the planning because I said, what if you carried on until retirement in this product? These are the figures I need to look at. If I want to be fair and honest, these are the figures. These figures are still quite atrocious, but these are the figures I used for the client. This is not his EAC, this is someone else's EAC breakdown, but I use the term to retirement, term to maturity figures. And that term to maturity figures for that client, as you will see here, was 0.8% for advice and 3% for other. And administration, I think, as well, was built into that. So 3.8% overall, excluding the investment management fees, which was also quite high. Just for the sake of giving this capital something to be consumed by, I just made up now a figure of 25,000 a month that this client must pay for in retirement for their share of the estate, for their share of the living expenses. And a growth assumption of the underlying investment will be inflation plus 4 to 5% per annum. Obviously, a retirement annuity, it can't go too aggressive. So what happened was, I stripped out the rest of the balance sheet, and this is what our software looks like when we plan with clients. It's a whale graph. And so what you can see here is just the RA in the balance sheet. I took everything else out. And you can see this RA starting at 1.8 now. You can see the person's age here, it's early 50s, and then going all the way to 65 when this person wants to draw a line in the sand and start consuming the capital. So if this RA is the only savings vehicle for this client, and say this RA must provide for 25,000 Rand per month in retirement, liquidity will become a problem at the age of 68. That's where the red starts. So that means that your income, the maximum income you can get from your RA, will be exceeded by your living expenses. At the age 68, it becomes a problem. So what I want to do is show you the benefits of a low-cost RA. Before that, you will just see here on the right-hand side, sorry, I missed it. At retirement, the value was about 5.3 million Rand of this RA. So 1.8 now, growing at inflation plus 4 to 5. I was being generous with this assumption though, because the underlying investment is rubbish. It's not going to reach that, but I want to give it a chance to impress. So inflation plus 4 to 5, 5.3 at retirement. So what we're going to do with this client is move them to a lower cost platform. This client has decided to rather pay me monthly. And so they're not going to have fees, my advice fees come off the investment. The administration cost for the platform, let's just say 0.22%. It'll probably be lower, but I haven't got to the stage with this client yet. And so that's the differences. Now, the only difference I made here was change the product. I didn't do any financial planning. I haven't even done any financial planning with this client in the sense of different asset allocation strategies, different drawdown strategies, retirement, contributing more towards other things, liquid investments. I haven't even done anything like change withdrawal at retirement from this. Like this is programmed to withdraw only the tax-free amount for both scenarios. So no influence from me as a financial planner. All we did was just change to a low-cost investment. 5.3 becomes 7.8 million at retirement. So it's 2.5 million Rand more that the person will have just from one product. And it provides 7 years additional liquidity. If I go back here quickly, with 68, that is when shopping at Woolworths becomes a problem. And now you can see 75. So 7 additional years liquidity, spending power in retirement. And this is without even really starting to do my job. I thought the example was quite powerful, but it shows you that, which aligns with our investment philosophy, is that excessive fees destroy wealth. And the numbers don't lie. So, does an investment that has a lower TIC, does it naturally imply that it will have better returns? Now, it might sound logical because if an investment gets 10% a year, and then the fund manager takes their 1.9% fee, it obviously reduces the return. Or if an investment manager charges 0.5%, and then they take that away from the 10%, you're obviously left with more. But it's not necessarily the case. There are hedge funds in South Africa, for example. At the moment, I was on a fund fact sheet. I didn't include in the presentation, but yesterday I was on one asset manager, a hedge fund manager's fund fact sheet. I think it was 6% fee, 6% TIC. The average return is 13% or something per year, and it is a moderate to aggressive risk equity allocation. Now, you're getting 14% net of fees or 13% net of fees per year. So that might sound great. Imagine if they didn't charge a fee, you get 20%, but they're obviously in it to run a business. However, so I made that example, but the research shows that a good indicator of future returns is the TIC, the investment cost. There's been research by Morningstar, for example, and I can refer to an article by Citywire a couple of years ago, a journalist called Patrick Kearns, where he cited Morningstar and Prescient Investment Management, where they talked about the correlation between low fees and investment returns. And they generally said the lower the fee, the more superior the return. Now, a lot of you on the call, I'm sure, are quite adept and astute with investing, and you will probably understand that this is probably, it speaks to passive investing or low cost indexation. And so passive investing does work. The data is out there for anyone to see on the SPIVA, SPIVA website. And so those are low cost investments. So low cost investing, there is a strong correlation, but it's not the be all and end all. It does come down to a case-by-case basis. So what I wanted to do here is do a little experiment. Now, I actually was not sure of the outcome of this experiment before I did this, so I thought it was quite interesting. So I thought, what if you, now I'm going to stick with the retirement annuity example. What if you had your own retirement annuity and you decided to create a portfolio, an investment portfolio made up of 4 underlying investment funds? This is what a lot of advisors do. A lot of DIY investors also have done this in the past. And so that's why I use this as an example. So if you take the 4 largest balanced funds in South Africa that are actively managed and that have a 10-year track record, that was a requirement to be included in this experiment. So say you include those 4 in this portfolio of yours, and then you give them each an equal allocation, so 25% each. Now, you can create that portfolio by actively managed companies like 91, Coronation, Allan Gray, MNG, FinEd, those types of companies. Those are active managers. And then what I wanted to see was, what if you compare the returns of that versus a portfolio made up of the 4 largest rules-based balanced funds in South Africa with 10-year track records. What does rules-based mean? It is indexation or passive funds, but it has multiple asset classes built into it. So it has bonds, it has cash, it has local equity, offshore equity. That's a proper multi-asset fund, multiple asset classes. Rules-based means that the fund manager manages it. When it's invested in equities, it's invested in the index. In bonds, it's probably in the bond tracker. But there are rules in place. They have rules. They say we must always be 35% global equities and 30% local equities and whatever. And they just stick to those rules. And then you get a passive multi-asset fund that is managed by someone. Examples of that are in a group Core Diversified, Core Accelerated, the Signia Skeleton Range, Satrix, all of those companies. They have rules-based balanced funds. So now I'm guilty in early in my career of creating portfolios like this for people. The top example. You just mash together the 4 biggest players, balance it out, and you should be fine. Now, if you take the same mindset and you take the 4 largest rules-based funds, what's the outcome? So the active balanced funds, I'm not going to name them here. It's not really the point of it, but it's just to show you the philosophy. So your aggregate return, your average return per annum over 1 year is 10.86, and then it goes to 9.5 over 5 years, 10.2, and so on. That is the combined return of this portfolio that you have created. And then the fee is 2.08%, the TIC for the same portfolio. Now, this data I got it from Morningstar, something we get in the industry every month, and it gives us the returns of every listed fund in South Africa. And then the TICs I got from the fund fact sheets based online for all of these respective companies. Some of them look ludicrously high. The reason is because they've got performance fees and they're doing well, so they're able to harvest some of those profits themselves. So you can see the average returns there over time. If we move on to rules-based, you will see here the returns as well, the average returns of this mashed up portfolio, and you will see the average TIC for this whole portfolio. And so what does that mean? The rules-based balanced funds, the combination thereof, outperformed the active combination portfolio quite handsomely. This calculation is the active less passive. So that row less that row. So you would think maybe sometimes active would outperform. That's what they say. Now going all the way back 10 years, it has underperformed. But look at the arbitrage in the fees. The TIC is a 1.53% difference in the TIC. So here you're paying a lot more to get sometimes a very similar result, other times a very different result. Unfortunately, all for the negative. So I've just showed you that. It's not advice. I'm not necessarily suggesting you take all these funds and mash them together. That's why I haven't given you the names. I could be in trouble for that. But it's just to show you that, yeah, fees do matter when it comes to investment management. But there are good fund managers out there that charge high fees, but they earn it and they deserve it. That is me for now.